Alright, listen carefully, because what we are about to discuss is not a trend, it is not a stock tip, and it is definitely not gambling disguised as investing. This is about how serious investors, the kind who think in decades, not weeks, actually allocate capital. Because here is a quiet truth most people discover too late. Wealth is rarely built through brilliant picks. It is built through intelligent structure. Today, we're going to take a wider look, not at what to buy, but at how professionals think about risk, uncertainty, and long-term growth. This is not financial advice, it is financial perspective. And perspective is what separates speculation from strategy. Let's begin with the biggest misconception about investing. Most people believe investing is about prediction, trying to guess the next tech giant, the next market rally, the next breakout. But professionals understand something deeper. The future is unknowable. So instead of predicting, they prepare. The real question is never what will go up. The real question is how exposed am I if I am wrong? This is the foundation of portfolio thinking. Let me give you a simple number that reshapes how professionals see risk. If you lose 50% of your capital, you don't need a 50% gain to recover, you need 100%. Losses compound faster than gains. This is why intelligent investors obsess over drawdown protection, not excitement. Avoiding catastrophic loss is more important than chasing extraordinary returns. And once you internalize this, your behavior changes. You stop swinging, you start allocating. Let's have a look at how professionals actually allocate capital. Let's walk through a conceptual example, not a recommendation. An illustration. Imagine a long-term investor navigating today's world. Persistent inflation risk, geopolitical fragmentation, AI-driven productivity shifts, and elevated asset valuations. A rational portfolio might look structurally diversified. For example, 40% global equities, broad exposure to innovation and economic growth, not betting on one country, not betting on one sector, owning the engine of capitalism itself. Historically, global equities have returned roughly 7 to 10% annually over long horizons, not every year, but over time. 20% high quality bonds, not exciting, but stabilizing. When equities panic, bonds often cushion volatility. Think of them less as return generators and more as shock absorbers. Professionals don't ask, will this make me rich? They ask, will this help me survive turbulence? 10 to 15% real assets, gold, infrastructure and commodities. Why? Because monetary regimes change, currencies weaken, liquidity cycles expand and contract. Gold, for example, has preserved purchasing power for centuries, not months. It is not about price spikes, it is about resilience. 10% strategic opportunities. This is where intelligent risk lives. AI, energy transition, semiconductors, biotech. High growth, higher volatility, but limited position sizing prevents catastrophic damage. Professionals never allow excitement to dominate structure. 10 to 15% cash or near cash. Cash is often misunderstood. People see it as doing nothing. Professionals see it as optionality. When markets panic, cash becomes opportunity because liquidity is power. Now let's move on to what smart investors avoid. Let me tell you what experienced investors quietly avoid. Concentration risk, emotional trading, leverage without discipline, and narrative chasing. They understand that markets are storytelling machines, but stories change, structure endures. Here is something rarely discussed. The greatest edge in investing is not intelligence, it is temperament. Can you stay rational when markets fall 20%? Can you avoid euphoria when everything is rising? Can you remain patient while others chase momentum? The market transfers wealth from the reactive to the disciplined, every cycle without exception. A structural shift happening now. We are entering a world defined by higher structural inflation than the 2010s, strategic competition between nations, massive AI capital expenditure, and energy system transformation. This suggests something important. The era of effortless returns may be behind us. Future investing may reward diversification, patience, strategic exposure more than aggressive speculation. Let me leave you with a principle institutional investors understand deeply. You do not build wealth by being right occasionally. You build wealth by being resilient consistently. A portfolio is not a bet, it is a system designed to survive multiple features because the feature never arrives exactly as predicted. So, when someone asks, what should I invest in? Perhaps the better question is, how should I prepare for uncertainty? Because intelligent investing is not about certainty, it is about durability. This is not financial advice, but it is how serious capital tends to think. And in a world growing more unpredictable, thinking structurally may be the ultimate advantage. Until next time, stay rational, stay patient, and always take the wider look.